Hi, this is Ray Evans and Brett Clark with the Infinitas Group, Infinitas Wealth Counsel, and the Pegasus team. And probably the two biggest questions that we get asked by clients right now are A, what do we think is going to happen with the presidential election and the impact on the markets? And B, interest rates are going down now. What are the likely impacts of that? Well, on October 15th, my son Jack Evans and I will have a virtual meeting, 12 o'clock Central Time. We'll record that meeting and we'll talk about presidential elections and the impacts on the market. So we won't spend any time on that today. But Brett Clark is here to talk about the likely impacts, the past impacts, primarily positive, of the Federal Reserve lowering interest rates. And as you know, we had our first interest rate cut in several years here just in the last month.
Yeah, so interest rates have been in the news quite a bit recently over the last couple years. It really started in 2022 when the Fed started to raise rates as inflation was spiking. Now that inflation has been steadily on the decline, the Fed, as Ray just said, has decided to start cutting rates, starting with the 50 basis point cut just here in mid-September. Now that it appears that we are in a rate cutting cycle, the question is how will that really impact the stock market? If we look at the last 100 years, there have been 22 main instances of rate cutting cycles that we can use as a guide. In 16 of those 22, the stock market over the next 12 months has been positive. The average annual return in those 22 cycles for the stock market has been up 11%. And really, if we get a soft landing as the Fed has, tried to give us, the average return is 17%. The Fed has signaled that they are going to continue to cut rates in November and December. The size of the rate cut will kind of depend on the economic data they're seeing at the time, but we'll continue to monitor that and the Fed moves and how the stock market reacts.
And probably the easiest stat to follow as you think about the Federal Reserve's policy moving forward is really the unemployment rate. Supposedly about 4.3% right now. That's actually a good number. A reminder that in the last 50 years, full employment is considered to be 5%, and that's actually considered a decent number. So we will track this, but so far we have had some positive reactions in the stock market, a lot of cash on the sidelines, and as interest rates decline, we expect a lot of that cash to go to at-risk assets, common stocks and real estate. If you'd like any more information on this and a great report that Brett has put together, ray.evans@pegasuskc.com.
Or brett.clark@pegasuskc.com.
Thanks very much. Look forward to visiting soon.